If you take a look at the portfolios of some of the biggest real estate private equity firms, you'll see some really common patterns when it comes to the markets they choose to invest in. And while every company's strategy will be a little bit different, there are a few best practices that are used almost universally by the most prominent investment and development firms within this industry. So in this video, I want to pull back the curtain on the private equity playbook for analyzing real estate markets based on my own experience working for and with these firms for almost a decade, and the most important things that tend to factor into these decisions. So when private equity firms are looking to place capital, the main goal of these investments is almost always to maximize potential upside for investors while minimizing their potential downside. And this means that these companies are going to be looking for markets where real estate values have a very high likelihood of rising and a very low likelihood of falling based on a few different factors that are very slow to change or very unlikely to change. And the first factor that these companies will often look at to identify an attractive market is geographic constraints that limit supply growth. This could be either a lack of available raw land to develop due to existing buildings that have already been constructed, or this could be water or other land masses that are going to prevent developers from building outward outside of a city center. This is one of the biggest reasons why markets like New York and San Francisco are home to some of the most expensive real estate in the US, with both of these cities having extremely little available raw land that isn't already accounted for, and both cities almost completely surrounded by water. Other markets like Boston, Miami, and Los Angeles would all fall into a similar category, with a body of water on at least one side of the city and years of development that's made raw land extremely difficult to come by. And when new buildings can't be built, this tends to increase the value of existing real estate in a market, since this makes it significantly more likely that the supply of new housing, warehouses, shopping centers, and even office buildings won't be able to keep up with even small increases in demand. And when demand growth outpaces supply growth in a real estate market, this drives up rents, drives down vacancy levels, and reduces the perceived risk with investing in a market, which directly increases prices that investors are willing to pay. And on the other side of the spectrum, this is also why cities like Dallas, Phoenix, and Las Vegas tend to attract significantly less interest from institutional investors, since these have historically been very cyclical real estate markets with intense boom and bust cycles and lots of available raw land that can easily be developed. Now, on top of looking for markets with geographic constraints, private equity firms also tend to look for political constraints in a market that make building new product extremely difficult. Cities like San Francisco and Los Angeles have notoriously restrictive zoning laws, a permitting process that can take years, and extremely strong community pushback when new developments are proposed. And in cities like New York, pre-construction costs can creep into the hundreds of thousands of dollars even before a project breaks ground, which can make it really tough for developers to justify new construction. And again, if developers can't build new product, this makes existing real estate in a market a lot more valuable, and this can often protect investors from major downward swings in things like rental rates or occupancy levels, and ultimately property values. This is also another reason why institutions will often be hesitant to invest in markets like Houston, Atlanta, or Orlando, which are known to have significantly fewer regulations than the cities we just talked about, which makes the development process a lot quicker and less expensive than in many other major metros throughout the United States. And speaking of costs incurred by developers, the next major factor that private equity firms will consider when analyzing a real estate market is the price per square foot, or the price per unit, to develop new product in relation to the prices they'd need to pay to buy existing operational real estate. This is what real estate investors refer to as replacement cost, which is essentially the cost to build a new similar property in the same location as an existing site, factoring in things like land costs, labor and material costs, and any other notable features at a property that would need to be recreated. And what private equity firms tend to look for here are markets where existing properties are selling for prices that are significantly below replacement cost, meaning that the cost to build is a lot higher than the cost to buy, and the rents that developers would have to charge to justify a new project would also be significantly higher than current market rates. This is also why a lot of major investment firms will shy away from cities where developers are known to be able to build new product very quickly and inexpensively again, since the cheaper it is to build newer, nicer buildings, the more competitive these are likely to be with existing properties in an area. Now, the last three factors we talked about have been exclusively related to the risk of supply growth in a market, but the demand for commercial real estate is also extremely important to the investment thesis of a real estate private equity firm, and this is where job growth projections come into play. At the same time that cities like New York and San Francisco have some of the most difficult permitting processes throughout the entire country, these are also some of the most densely concentrated employment hubs in the US, with top talent in the tech and finance fields moving to these cities every single day. In San Francisco, for example, the hype of all the advancements in AI has led to a huge amount of growth in the market, with 1 out of every 4 square feet of office space being leased by AI companies over the last 2.5 years, and many of these companies offering extremely high salaries and even profit-sharing plans for employees. Miami has also been a really good example of this since really the spring of 2020, with a lot of companies relocating to this area from higher tax states, resulting in real estate values rising extremely fast in this market, including housing prices growing by more than 60% since the end of 2019. And when the demand for housing spikes in a market, this also tends to create an increased demand for all other types of commercial real estate, including retail space for new residents to shop at, industrial space to get goods to these new residents sooner, and office buildings to create spaces for these people to go to work every day. And again, this is in contrast to a lot of cities in the South or the Sun Belt with a significantly smaller job market and significantly weaker long-term job growth prospects, which can make these cities a lot less appealing to institutional capital. Now, what makes private equity's market selection criteria so powerful is how these factors all work together to maximize investor upside and limit investor downside. The combination of very low supply growth risk as a result of raw land constraints and a difficult and costly development process alongside a very high likelihood of continued job growth over time tends to stack the odds in an investor's favor. And even though market conditions can fluctuate over time like we've seen over the last few years, when it comes to sustainable long-term rent and value growth, this is the formula that private equity firms tend to rely on. And if you want to learn more about the investment analysis process that's used by these companies and how these firms both build and use real estate financial models to value commercial real estate, make sure to check out our all-in-one membership training platform, Breaking a CRE Academy. A membership to the Academy will give you instant access to over 120 hours of video training on real estate financial modeling and analysis. You'll get access to hundreds of practice Excel interview exam questions, sample acquisition case studies, and you'll also get access to the Breaking a CRE Analyst Certification exam, which covers topics like real estate pro forma and development modeling, commercial real estate lease modeling, equity waterfall modeling, and many other real estate financial analysis concepts that will help you prove to employers that you have what it takes to tackle the responsibilities of an analyst or associate at a top real estate firm. And if you like this video and want to see more content on real estate investment strategies or market analysis best practices, make sure to hit the like button and let me know. And let me know in the comments any other characteristics you look for when you're analyzing a market. As always, thanks so much for watching, guys. I hope you found this helpful. Subscribe to the channel if you haven't already to see more videos like this every single week, and I'll see you in the next video.